Good morning, everyone. My name is Samantha Grant, and I lead U.S. Equities Manager Research at Marquette Associates. Today, I'll be discussing the impact of technology on investing in U.S. equities and the value growth continuum. The agenda will be as follows. First, we'll talk about periods of growth outperformance, followed by an overview of the value growth continuum. Then we'll wrap up by comparing the tech bubble to today's market environment, and then we'll take a guess at when this period of growth outperformance might end. Does anyone here remember this sock puppet? Okay, I hear yes, but I think we have a few millennials in the room, so I'll explain. Maybe you'll remember that this sock puppet was the mascot for Pets.com, a now bankrupt e-tailer of pet supplies. But maybe everyone will remember a few of the other brands listed here. Investors went crazy over these stocks because they were very high-flying during the late 1990s. The point is, none of these stocks are here today. Similar to today, the introduction of the internet for mass consumption spawned new business models that challenged traditional ones. The media outlets talked about concepts like the new economy, software stocks, and growth investing. As the euphoria grew, investors poured money into stocks like Microsoft and Intel, which were more established, and also into newcomer stocks like Amazon and Yahoo. But like the saying goes, what goes up must come down. And many of these companies that were hailed as disruptors of the day ultimately closed within a few months of going public. These companies broke the first rule of business, which is to make money. The tech bubble burst in March 2000 and didn't end until October 2002. Undoubtedly, investors learned that the bursting of any bubble could be long, painful, and sudden. Overall, the crash wiped out $6 trillion in shareholder wealth, and the NASDAQ took another 13 years to reach its former highs. One of the biggest and probably most unexpected beneficiaries of the tech crash were value stocks. From the bottom of the crash in 2002 to the top of the market in 2007, the value premium surged. Value outperformed growth by a whopping 55% during that time. Ultimately, investors learned that the price you pay for a stock today does and will matter in the future. But this is how markets work. Styles go in and out of favor, and stocks become over and undervalued. This is what I would describe as the value growth continuum. Let me explain. Companies change over time, their investor bases change too, and their logos change. This is Microsoft's original logo from the 1980s. During the 1980s and late 1990s, investors were willing to pay up for Microsoft's earnings under the belief that the company had sustainable growth prospects. This is where a growth investor would buy the firm. As long as Microsoft hits certain targets, growth investors stay invested in the stock. But things don't always go as planned. After the tech crisis, Microsoft entered a period of stagnation and decline. The company was wasting money on, businesses that weren't making any money, and they lacked innovative direction. This is where a growth investor sells. However, eventually things decline badly enough that a value investor thinks Microsoft looks like a bargain. The value investor would look at Microsoft and say, well, they still have really good products like Office and Windows, and they still make a lot of money. This is a bargain. Eventually, Microsoft returned to growth, and as the growth investor as the value investor sells a stock, the growth investor becomes interested in Microsoft's new growth story. So we've established that companies oscillate over time between growth and value. However, historically, value has given investors the most bang for their buck. Here we show the rolling 10-year returns of value since 1926. When the blue and green lines are above the black line, value is outperforming. When the blue and green lines are below the black line, value is underperforming. You can see from this chart that there has been a consistent value premium over time. What you'll also notice is that value's underperformance has been pretty rare and also fairly recent. So the last time the value premium was negative was briefly in the late 1990s during the run-up to the tech bubble. What makes today's environment challenging is that the duration of value's underperformance has been quite long. So now we've seen 2 periods of growth outperformance, and we have to ask ourselves, after 10 years of value underperformance, is this time different? So let's take a look at the NASDAQ, a leading index of technology stocks. Let's take a look at it near the peak of the tech bubble in 1999 and compare it to today's NASDAQ in 2018. So focusing in on price to earnings, you'll see that in 1999, the price to earnings ratio was 3 times the level that it is today. Clearly, growth investors were overzealous about tech stocks then. Another big difference is between the average market cap and the median company age. Tech companies today are on average 6 years older and 10 times larger than they were back then. This speaks to the maturity and the stability of tech stocks today. So we can all agree, after 20 years after the tech bubble burst, that investors were right that companies like Microsoft and Amazon would be titans one day. They were just wrong about the price and the timing. And many of us can't imagine living without some of the apps listed on this slide. This is what makes technology's run-up more deserving today. In the late 1990s, technology firms were focused on building the infrastructure of the internet. This created very cyclical companies that were dependent on corporate sales. However, today's firms are focused on, software-based and focused on putting out products directly to consumers and businesses. So case in point, here we show the number of years that it took for some of these applications to reach 1 billion monthly average users. You'll notice Microsoft is the squares at the top of the chart. It took them over 20 years to reach 1 billion monthly average users. However, if you look at Facebook's Instagram, the last line in the chart, it took them less than half the time to reach the same milestone. And I would be remiss if I didn't touch on Amazon. It is the second company behind Apple to reach $1 trillion market cap. Amazon had its initial public offering in May 1997 at $18 a share. That's equivalent to $1.50 today and pales in comparison to the 2000 stock price that's on the Amazon today. It crashed along with other tech stocks after the tech bubble burst, but then it rebuilt itself and finally turned its first full year profit in 2003. So here we have the physical depiction of Amazon's growth. This is Jeff Bezos' first Amazon office, and you'll see the DIY Amazon.com banner on his wall. This is Jeff's current digs. He's clearly upgraded and is now looking for a second headquarters, which will hopefully be Chicago. So this is the business depiction of Amazon's growth. So over the last 8 years, e-commerce sales growth has grown at 82%. Amazon sales growth has grown 8 times faster than all other e-commerce growth. Analysts now estimate that 50% of all e-commerce sales will take place on Amazon within the next 2 years. So seemingly, technology has turned into a winner-takes-all environment. Here we show the top 5 stocks in the S&P 500, otherwise known as FANG and whatever derivation you'd like to use. Not only have most stock market gains accrued to these stocks over this time, but so have the revenue gains. Each firm is larger today than it was 10 years ago. Just look at Apple. In 2009, they had $36 billion in annual revenues, and today that number is $229 billion. Things have been more mixed on the value side. Here we have the largest 5 stocks in the Russell 1000 Value Index. In 2009, their revenues quadrupled the revenues of the FANG stocks. So while revenues have grown for the value companies as a whole, particularly for value investor-led Berkshire Hathaway, which is run by famed investor Warren Buffett, you can see that revenues have shrunk for some of the value companies. So look at ExxonMobil and JP Morgan. And this stagnation belies what we've seen in sector performance. Since the financial crisis, the consumer discretionary sector led by Amazon and the technology sector led by the rest of the FANG stocks have outperformed traditionally value sectors like energy and financials. Each bank's company is taking advantage of secular trends like faster and increased access to the internet and the proliferation of the mobile phone. But eventually, these trends could slow and growth may not be the best game in town. And the slowdown could come sooner than you think. Last month, this bull market became the longest one in history, and no one could have predicted that 10 years ago. Usually, in the early phase of the business cycle, the consumer discretionary, technology, and industrial sectors outperform. And this is sort of what we've seen over this time period. However, economists now believe that we're entering the late expansion phase of the business cycle. You'll notice that more traditionally value sectors like energy, consumer staples, and healthcare typically outperform. So given where we are in the business cycle, here are a few things that could cause growth to slow. The first would be valuations. Here we list a number of different valuation metrics, starting with price to earnings and ending with price to cash flow. Typically, value stocks have lower cash flows and book values relative to growth stocks who have usually higher price to earnings. So let's focus on the price to earnings part of the chart. You'll notice that both growth and value stocks are trading at a premium relative to their 10-year average. However, growth stocks are trading at a 30% premium, while value stocks are trading at a 20% premium. You'll also notice that growth is much richer across the board. The second headwind for growth could be future incremental benefits from tax reform. Overall, lowering the corporate tax rate has been a success. John already mentioned that earnings growth have been north of 17% year over year. What is not discussed as much is the impact of tax reform at the sector level. You'll notice the green bars are financials, consumer discretionary, and consumer staple sectors. At least 58% of the stocks in these sectors had effective tax rates above 30%. Seemingly, these sectors should be the primary beneficiaries of tax reform. These are also more value-oriented sectors. And hopefully some of these tax savings can be used to make value firms more competitive. Here we show a list of value-oriented firms that are in the middle of restructuring their businesses. Similar to the Microsoft example earlier, GE, a value stock, has entered a period of stagnation. However, the company's future could be brighter than its recent past. The firm recently got a new CEO, is selling off money-losing businesses, and has decided to focus on their core strengths, power, aviation, and renewable energy. Only time will tell, though, if GE can be a success again. And so, what do value company restructurings mean for you as an investor? Hopefully, it means that value's underperformance streak could be coming to an end soon. In the context of the value growth continuum, value has definitely had it tough over the past 10 years. Sure, growth's outperformance has been supported by strong business fundamentals like the proliferation of the mobile phone and faster access to the internet, but eventually these trends will slow. So just like the cyclical performance of US versus non-US stocks, style performance can be cyclical too. And when that performance reversal comes for value, we expect it to be strong and sudden. Something so similar to what we saw after the tech bubble or similar to what we saw in the post-election environment in 2016. As a result, we believe that clients should stick to their long-term strategic asset allocation and not chase relative growth outperformance. So this concludes the first session of Flash Talks. We really appreciate you being here today. We'll take a 5 to 10 minute break, and then we'll resume the second session of Flash Talks. Thank you.